RBI has kept interest rates as it is in today's MPC meet, but that's not the big story. The real headline is the cut in the cash reserve ratio. So what is the CRR and why should we care? Well, think of the CRR as the portion of a bank's deposit that it must park as cash with the RBI. For example, if the CRR is 4%, then for every 100 a bank raises in deposits, it has to set aside 4 rupees with the RBI. Right now, this CRR has been cut to 4% from 4.5. It's a way for RBI to keep things stable, manage risks, and control the flow of money in the market, and keeping these reserves helps banks stay smooth and liquid. The idea is to ensure that banks have enough reserves to stay afloat during uncertain times. And in banking, liquidity is everything. It decides how quickly a bank can access cash when needed. It's all about having those enough assets that can easily be turned into cash whenever a demand arises. But here's a catch with CRR. Banks do not earn any interest on the money and they can't lend or even invest it. It's just parked there untouched. So now by cutting the CRR, the RBI is essentially freeing up money for banks. In fact, some estimates suggest that this could release about 1.16 lakh crore for banks to lend. This extra liquidity could give a solid boost to lending and hopefully and ultimately support economic growth.